Hi, folks. As Roland said, my name is Adnan El-Araby. I'm one of the co-portfolio managers on the BEMO Investment Trust. I was here last year to talk about the same investment trust, and I see some familiar faces here. What the trust does is invest in a specific part of emerging markets. So most investors and asset allocators, when they talk emerging markets, we're always talking about EM Asia. EM Asia is, over the last 20 years, has become almost 80% of what is a global emerging market fund. So when you're buying a global emerging market fund, your exposure to Asia is quite high. The other two parts of global emerging markets, or the other two regions of global emerging markets, there's Latin America, which is dominated by Brazil and Mexico. Obviously, Brazil is a very large country with a large economy and a large population, and both countries benefit from being with close proximity to the US. The region that we're looking to talk about today is EM EMEA, and that's what the trust focuses on. EM EMEA is about 15%, and it's the second largest part of global emerging markets after EM Asia. And the first thing you see here in terms of geographical span is that you have three almost distinct regions within EM EMEA. So the Middle East has different demographics, has different economic drivers, different politics to Africa, and obviously emerging Europe also has a completely different demographic manufacturing base, a highly educated workforce, and they also benefit from having such a close proximity to the EU. Russia used to be a part of the investable world, but since the Ukraine conflict, and we'll get on to Russia and sort of the recent headlines around Russia and Ukraine conflict. So if we look at it and break it down, now we invest across the entire region and across the entire map. What we're highlighting here is some of the larger markets that we actually invest in where we see a lot of opportunity, and we've seen a lot of opportunity over the last 20 years. Poland has been a very strong market for us and a very strong economy. Greece, Hungary, Turkey is in a very unique position where it actually straddles both. So it has some of the favorable demographic and the strong economy, same as the Middle East. And then on the emerging European side, you've got a very highly educated workforce, and also a strong manufacturing base and a close proximity to Europe. In the Middle East, these are the four largest markets, but really where we see a lot of opportunity is in the UAE and Saudi Arabia. The other two parts are much smaller, and here where the opportunity is. And Africa, as always, Africa always has potential, but you have to be extremely selective. And we'll talk about how we construct the portfolios, but to be very simple, you always have to start with understand where the risk lies, right? How much do you stand to lose first before you can figure out where your upside comes from? So with EM Asia, as I said, China and EM Asia make about 80% of the global emerging market benchmark. EM EMEA itself has a very low correlation to China and to EM Asia. So the magic number here for us is below 0.5. What that means is basically whatever happens in China and the financial market in China, how much does it affect this region? And currently, it consistently actually affects it less and less and less across the entire region. So that's EM Europe, that's Middle East, and Africa, where if you can see, obviously, in EM and China, it's almost correlated to itself. Okay? Why is it less correlated to China? Because within EM EMEA, you have three distinct regions. Again, so what happens in EM Europe doesn't actually impact what goes on in the Middle East. What happens in the Middle East doesn't necessarily impact what goes on in Africa. And as you can see here, again, all three regions are completely different and distinct within the operating economics of it and also within actually demographics and the politics. Now, why does that matter? It matters because what we're trying to argue here is that active management actually plays a big role in terms of investing and actually generating returns within that region versus the ETF. Right? So if we can start from 2021, you could see the Middle East outperformed not only EM, but also outperformed developed markets. From year to year, in 2022, it was the Middle East and South Africa that really generated strong returns compared to EM and DM. And then again, in 2023, South Africa and Middle East didn't do very well, but EM Europe has outperformed both EM and DM. And obviously in 2024, this is predominantly US exceptionalism and the AI trade here in developed markets, which is something that our region and most emerging markets can't compete with. Obviously, China has a competitive role to play in that, but for our region, we don't have that. But as you can see, what we're trying to highlight here is that there's always opportunity in one of the regions, depending on depending on which year and what economic drives are happening. Also, obviously, politics always reigns supreme in emerging markets, and in EMEA, it's no different. So you kind of have to understand, again, start from where does the risk lie, and then where's the opportunity after you better understand where the risk is. This is just to show, some people would like to look at it from a longer term perspective. So this is an annualized return. The three regions within EMEA, South Africa, Middle East, and EM Europe, have outperformed the wider emerging market benchmark. But obviously here, the developed market is predominantly US exceptionalism, but I would argue that the dynamics around that and the risk rewards around the US exceptionalism is probably changing as we continue on throughout this year and next. This is really just to show that since Asia became such a big part of the global emerging markets, a lot of the resources are being allocated to Asia. This creates inefficiencies in where we invest, but also creates opportunity for active managers to be able to kind of highlight where we can actually find opportunity and where the liquidity is within that region. So this is the performance of the trust. We annualized it, and it's net of fees, so it's net of what the charges on the fund, on the trust, that is, over the last 10 years. Happy to report, and very much credit to the team, myself, my co-manager, and one other investor. We've managed to deliver positive absolute returns 6 out of the last 10 years. 2 out of the 4 years where we underperformed on an absolute level were the pandemic and the Russia-Ukraine conflict. And then on a relative basis, if you look at it that way, we outperformed the benchmark 7 out of the last 10 years. Again, 2 out of the 3 were the pandemic and the Ukraine-Russia conflict in 2022. So again, this is the same chart just showing it annualized, as some people would like to look at it from a much longer term. The trust has outperformed EM and EM LATAM. EM Asia has outperformed the trust, but I would argue that in the first 5 years, the investment case for China was much more compelling. It had a much higher growth rate. The politics were much more benign as before, since in the beginning. So what we're trying to show here is that the investment trust within EMEA and emerging markets is very limited. As you can see here, 9% of all of the sort of existing investment trusts cover EM. And then within EM, the EM EMEA is one of the only trusts where it has an institutional investment team that's been looking and dedicated to the region for over 20 years. We've been looking at it now for a very long time. We've gone through many political sort of turmoils, pandemics, et cetera. And we're happy to report that we had some competitors, but the Russia-Ukraine war actually damaged a lot of our competitors. But the trust is still going. The team still managed approximately about $1 billion in assets, and the trust sits within our entire AUM. This is just a breakout of what we currently own and what the trust is, where the trust is allocating some of our investments. Okay, so this is the outlook, and we always have to have an outlook slide. To sum it all up, and I'm probably going to state the obvious here, is that probably for the next 18 to 24 months, uncertainty would be the sort of the word that you would use to describe the economic outlook, the investment outlook, and over that, it's ever more exacerbated by the headlines that's being brought out by the Trump administration, right? Because you get headlines after headline, but there's very little substance behind it and very little detail. So we kind of have to roll forward slowly and get a better understanding of what the actual full picture could look like, right? So the next two sort of highlights inflation, interest rates. Okay, well, inflation can come down, but if businesses are investing less because they don't know what the long-term return is for that capex is, or if U.S. government workers are not making big purchases because they don't know if they're going to have a job tomorrow, or a migrant worker not investing or not buying anything because they might get deported from the U.S., all that consumption investments come down, inflation does come down, but you actually have a much slower economic growth, and then the Fed is sort of caught between a rock and a hard place where do they cut rates, or is inflation going to remain high because of the tariffs? Peace in Ukraine, I probably wouldn't describe it as peace. We have it as peace in Ukraine, but it's probably more of a settlement or an agreement to sort of stop hostilities, and we'll talk about that. And obviously, this could be an endless discussion. So the way we're going to look at it, the way we're going to discuss it is how does it impact the trust? And in our region, how does that work? Who wins and who loses in terms of the countries that we invest in? So the tariffs, as you can see here, these are the sort of the countries that could be impacted by the Trump administration's tariffs or intention to tariff some of these countries. None of the countries that are in the EMEA are under this in this chart. That's not to say it's a zero risk. It's just that the magnitude of the risk is much, much lower, and the probability is much, much lower. And I could even argue that maybe, for example, someone like Turkey will actually benefit greatly. And we'll talk about where the winners and losers are. For the trust, specifically for the trust, we used to invest in Russia before it was removed from the MSCI benchmark. If Russia does negotiate a way back into the fold, where it becomes part of and gets reattached to the global financial system, there are assets in Russia that the trust owns that are still there, and we know that they're still there because we have a record of it. That obviously becomes part of the trust again and gets revalued higher. Also, if Russia opens up, then there's an opportunity to invest in that market again at probably very attractive valuation. The second thing, interest rates. Without getting too much into the weeds, we came into the year thinking that the Fed is only going to cut once because inflation remained high and the economy was very strong. Now the market's already pricing in 3 cuts, and that's when we built this chart. So you could actually see that slope become even steeper. Again, active management here will help out because we know, for example, in emerging Europe, banks will benefit from higher rates. In the Middle East, there are banks that actually will benefit from lower rates versus the higher rates. So really just get a better understanding where the risk reward lie, and that's where we're trying to highlight is that ETFs in general for emerging markets and for such a regional emerging market doesn't necessarily give you proper exposure and doesn't actually enhance your risk return objectives. Okay, so we're on to Ukraine, and this $500 billion sort of number that everyone sort of keeps touting and keeps discussing and the potential for that. I would say that $500 billion number is probably the most optimistic scenario of what could actually happen. So how can we get to $500 billion? That means Russia gives back most of the territory they've taken. Yeah. The Western allies actually take the Russian frozen assets and use them to actually rebuild Ukraine. And most likely, whoever the president of Ukraine is much more leaning towards the West, right? I think a more realistic scenario is where Russia obviously has a seat at the bargaining table, which it does, and they will actually receive some sort of concessions, if I could call it that. So let's assume that they keep some of the land they've taken, or they keep all of the land they've taken. Let's assume that the president of Ukraine or the next president of Ukraine is more neutral instead of westward leaning. So then what happens? Well, that number probably drops to about 300 billion. There's not to say that, and then most of the steel, most of the cement could be coming from Russia and the EU. It doesn't necessarily mean it has to be all EU. That some of that money, the Russian money, will be unlocked but brought back to Russia. So it's not necessarily a very straightforward. And again, I talk about uncertainty, I talk about headlines, I talk about lack of detail, and that's one that's in the headlines today. We've heard about it for the last 3 weeks, and we'll continue to hear about it to get a better understanding of where we are. One big winner here in our region is Turkey. Turkey has been pragmatic, it's been neutral across both sides for the last 4 or 5 years. It has the manufacturing base, it has the ability to actually deliver on steel, on cement, it has construction companies. Most of its construction companies are actually responsible for building most of the US embassies outside of the US. So they have the know-how, they have the relationships, and they also have the resources and the manufacturing base. So Turkey will be a winner regardless of where the detail is. And so that's something that we continue to watch to get a better understanding of. And we're positioned for that. They told me I have to show this, so I'm showing you this. 1, 2, and I think you can have the presentation. So, okay, do we have the chart? Okay, it ends here. It ends here. What time is it? Yep. Okay, perfect.
Okay. Adnan, you ready for questions?
Yes.
Okay, lovely. Do you have any questions for Adnan, please? Remember to raise your hand and then wait for the microphone to come over. And we'll be with you in a second. I've got one quickly before you get going. Then.
Sure.
The Russian assets.
Yeah.
So does the trust currently own Russian assets? And are they valued now at zero, or what are they valued at the moment?
Yeah, so we do own Russian assets. All of the assets are valued at zero, even though they have a value, and we know what that value is. But at the point now, if you're invested in the trust, there is zero value to the Russian assets. If Russia gets brought back from the cold and reattached to the global financial system, then there's a value to that, and so then the net asset value of the trust would increase by that value. We have shares, but we also have cash. So the companies that we own pay a dividend. That money goes into what they call an S account, and the money is sitting there accumulating.
So those Russian assets could have been paying a dividend since the assets have been written down to zero, and that money is then just built up.
It's just sitting in the cash. And we don't have access to that. We
would
can't
become the legal owner, that would come to you.
As of now, we are the legal owners, but we can't touch it.
Yeah. Question here, please, Steve?
Your presentation showed good returns.
Yes.
But your dividend is 3 to 5% historically.
Yeah.
What causes the big difference?
So our objective is to deliver performance first, and then as a function of the companies that we invest in, and as a function of the region, there are a lot of companies that pay a dividend. And so we accumulate, and we try to pay a dividend every single year. We've paid a dividend every single year for the last 10 years. So we're not necessarily focused on generating a 5% dividend yield. We're focused on generating capital gains, and then on top of that, we pay a dividend from what comes out from the companies that we're holding. So it's a function of what are the companies that we hold. Now, when Russia was part of the investment portfolio, those particular companies paid a much higher dividend, and hence our dividend for the trust was much higher.
Okay. Question down the front here, please, Steve. Thank you.
Thanks for the presentation. Quick question. You mentioned the current Russian assets and
Yes.
cash is zero.
Yeah.
And what was it before it was frozen? What was the value before?
Phil, do you remember? 25%. About 25% of the
in dollar terms?
Sorry?
In dollar terms?
Yes, yeah. It's all in dollar terms. Yeah, yes.
What was
it?
It?
So what was it? I think it was about 30 to 35 million, let's say approximately, dollars.
And on the charts where you showed the breakdown by individual country,
yeah.
I think you had Poland at around 8%. Is that right?
Yeah.
Here we are.
Yeah.
A lot of people talk about Poland as being like the new engine of Europe and a real driving force. It's not a market I'm hugely familiar with. What's the structure of the listed companies market like in Poland? Is there depth of equities there? What does Poland look like?
So the really great thing about the region, especially over the last 10 years, is that there's an asset management industry across the region, whether it's in emerging Europe, even South Africa, or the Middle East, right? And so the markets get deeper and deeper, and they're funded from local investors. So they're not looking for international capital to come in to create liquidity. With Poland specifically, to your point, it's been a fantastic economy. It almost runs at a developed market standard. They have a very high educated workforce. The manufacturing base is very good. The rule of law is very good so far, at least for now. And so the market, initially was dominated by banks, but now you're seeing e-commerce plays, you're seeing consumer plays, supermarkets, resources, and manufacturing. So it's quite a diverse market for now.
Okay. Any other questions? I've got a couple more otherwise. One for me then.
This gentleman here.
Oh, sorry. Okay, yes. Thank you.
What is your split between publicly listed companies and private equity?
It's all publicly listed.
Okay.
And we actually make a point to be very liquid in the investments that we hold, because simply in emerging markets things will go wrong, and we don't want to sort of be married to something that we just have to say, okay, it's gone wrong, and we have to write it off to zero. So for us, we're a public market vehicle. When we make an investment, like I said, our first starting point is, well, how much do we stand to lose if we actually make this? And it goes to, the investment case goes wrong, right? But we have to be able to exit and get out, so we don't have any private assets.
I was going to ask, you made the case for active management rather than passive for this asset class, for this region. I was wondering how differentiated you are then to the index, both by geography and by the sectors that you invest in.
Yeah, so we're about approximately between 40 to 50 names within the benchmark. We try to move away from the benchmark because most of the returns are actually happening below the largest names. The largest names, at least in our region, and you'll see that probably across global emerging markets, the largest names in the benchmark are often cyclical, which means like they're quite volatile, they're often government related, they're inefficient, they're badly managed, and so you get a lot more volatility for not much return in terms of, they become just a trade versus an investment. And so we often actually move away, and your sweet spot is sort of the second tier, well-managed companies. They've been around for at least 5 to 10 years. They've kind of gone through the economic cycle more than once, and you kind of understand where the management's track record is working through that cyclicality.
Lovely. Any other final questions for Adnan? No? Okay. Thank you very much indeed. Thank you for the presentation. It was terrific.